Mr. Carter.
Good afternoon. How are you?
It's Luke Hannon with the Next Generation Podcast. How are you?
I'm doing real well, Luke. And yourself?
I'm doing good. Welcome on. We're so glad to have you on. It's just me today. Max is out on the beach, so we'll spare you having to talk to Max. Does that sound fair?
That sounds fair. Someone has to be on the beach today. It might as well be Max.
It might as well be Max and his new family, I guess. So he deserves the break.
Right.
He deserves the break.
That's right. That's right. Well, Luke, you may not know, but I will tell you, him with his new family on the beach is not actually a break. It's probably more work than he's doing with a babysitter at home. So
that's true.
Our thoughts are with Max and cleaning out sand and all crevices and
That's true. Yeah. He's been a good parent so far. He's serving his family well. So
good.
He's taking it down to Florida.
That's the goal.
I feel like calling Cowherd right now. I've got a camera on me and it's just me. Are you a fan of the herd?
I am. Do you get paid as much as Colin Cowherd?
I don't, unfortunately.
Not yet.
Yeah.
We're going to make this podcast go viral, and it could spring you into the Scott Van Pelt world. Who knows?
Consider this your audition to be my Stanford Steve alongside
me. I have been called worse.
Well, cool. Well, hey, thanks for jumping on. I'm actually really excited for this episode to kind of introduce some of our listeners to the mortgage industry. It's something that Max and I are not, experts in, but you are, and you've been doing this for a really long time. And so I'm really excited to have you on and just to be able to talk about, how you landed at Generations Mortgage and, what you're doing today and drop some truth bombs on us. So, I just kind of want to start with your story. Today you're at Generations Mortgage, but tell us a little bit about your career, where you're from as well, and, your path to what you're doing today.
Okay, well, a lot about my career and upbringing actually ties into the whole Generations Bank scenario. So I worked for my family right out of college. Actually, my first job out of college, I worked for Alltel Mobile and sold cellular phones. And I was actually the first person in the United States, because Alltel was an Arkansas-based company at the time, to sell cellular phones in Sam's Clubs. I was the guinea pig for that. So I did that career for about a year and a half. And then my father approached me to work for our family business, and I did that for quite some time. And then ended up selling that, which was a good move, good timing, and had a good friend of mine that was a similar situation. His family owned a smaller community bank in central eastern Arkansas, and I went down and started kind of shadowing him in his Little Rock office where he was doing loans for the secondary market. And I did that for a little while, and then kind of was released to the hounds up here to do it on my own via him, and did that for a while, and then saw kind of some writing on the wall that I could probably do better doing it on my own, owning my own business as a mortgage broker. I did that for a while, many years, and then, the industry changed a little bit, testing, guidelines, compliance, a lot of those things started squeezing the mortgage brokers a little bit to where it was making it a lot harder. So at that point, it kind of got back to my roots and did some brainstorming and thought about people that I knew up here in Northwest Arkansas in the banking industry that owned banks, et cetera. And, the first person that came to mind was John Harrell. So I grew up in Camden, about 4 doors down from the Harrells, and my family and John's family were great friends growing up and still dear friends from years ago. And so I approached John about it, and Cersei was alive at the time. And I'll never forget, we had a meeting, which was right off Dixon Street where my office was, right next to George's Majestic Lounge. Underneath, it's like in a basement. I'll never forget John and Cersei having to duck to get in the door. It was kind of a hole in the wall, but it worked great for us. And we came down and we talked about, how can I take my crew and get with the bank and not necessarily, merge into one thing, but how could we help each other? And, anytime you can have a bank like that has assets and then a separate mortgage entity that has some knowledge and stuff, it kind of worked out for both of us. So we did that for a while, and then it became easier just to kind of fold in with the bank and, not necessarily have all the other loose ends. So I guess my first day of really being affiliated with Generations Bank, which was First Bank at the time, the very start of the journey would be January 1st, 2009. So that's about 14 and a half years ago. I don't know if I get anything for a 15-year anniversary, probably not, but
maybe
probably
a blanket.
Coming up yeah, hopefully a big sweatshirt, maybe. I don't know. Maybe a cookout. I'll take a cookout. But anyway,
I'll come down there and grill you a steak.
Yeah. Perfect. Ribeye medium rare, be good.
Good deal.
So and so since then we've just kind of done that, and Generations has kind of turned me loose to be the guy to head up all the mortgage division. And when I say mortgage, I don't necessarily mean like all mortgages. Our mortgage division focuses solely on the secondary market. So that's what I do here. I run the secondary market show for all the lenders that are here at the bank that have access to do that. And it's a completely different world than what we call in-house lending or commercial lending and those kind of things. But that's kind of my history.
Yeah.
How I got here, and it's been a great run, and I don't see any end in sight. I hope.
Yeah.
God willing.
Do you like living in your Fayetteville, right?
I'm in Fayetteville. I came to college in Fayetteville in 1989, graduated at the university 4 years later, and never left and never have a desire to leave. I love it here. It's a fantastic place. It's a melting pot of all different types.
Yeah. So if you would have done poorly in classes, you could have been around for a national championship. Is that what I hear?
Well, funny you bring that up. I actually went to that national championship.
Oh, did you really?
Keep in mind that time technology was not what it is now. So I think probably the time periods run out where I could get in any trouble. But there were 4 or 5 guys I graduated with that were friends with 4 or 5 guys a year or two younger, and we went out there and I just reused my student ID that didn't have a barcode or any kind of swiping capability, and bought student tickets and just acted like I was still in college and enjoyed it. So
that is awesome. Yeah, you can't cheat the system like that anymore.
No, not anymore. And I don't mind. It was a great experience. That was the very first time in my life I ever missed Easter Sunday with my grandmother and grandfather and family in Camden. And that was probably the hardest call, was to ask if I could miss Easter. and I got the blessing, no pun intending. And, and we went from there.
Yeah. Well, at least we won,
Exactly. Yeah.
That's awesome. Well, good deal. Hey, I know you were talking about the secondary market. I think for most people who have bought a house, everybody knows that their mortgage gets sold on the secondary market, but that phrase, that term, can be a little not scary, but just there's a little bit of unknown there. And so I'd love for you to kind of speak into what is the secondary market, and how did that kind of start?
Okay, well, I don't really know when it fully started, but the secondary market is basically backed by government entities, Fannie Mae and Freddie Mac.
Okay.
They have their set of guidelines, and it's kind of like square boxes, and you don't deviate.
Yeah.
It's not the good old boy system. Oh, he's got $200,000 in the bank, we'll let him slide and go ahead and get this loan done. It doesn't work that way with us. It's pretty much, you have a set of guidelines you have to adhere, check all the boxes. And then I think what happens then is, these investors, they will get these loans and they put them in what they call buckets and sell them to Fannie Mae in large quantities, and they're paid for them. And, these places get rated, depending on how how big the loan amount is, what the interest rate is, what the borrower's profile is, and whatnot. But generally the secondary market, the big difference is those are the loans that can be the 15, 20, 30-year fixed loans. When you go to a bank and do an in-house loan, you're generally going to get 5 years max before it balloons or you have to refinance it. These are the ones that you lock your interest rate in and it's set there for 30 years, 15 years, 20 years. That's why it's so popular. And generally the rates on these are lower than in-house loans. So it's the goal for most people to do that, to get the better rate and get it locked in because it's security. I mean, your payment's not going to change with the principal and interest for that period of time, and it's easy to budget and go from there.
Yeah. Would you say that that's the majority of homes are on the secondary market? Like, are we looking at 90% of homes, or I know you said there's a lot of boxes to check.
Yeah, I don't know if it would be that many, Luke, but I guarantee you it's probably over 50%, just because this day and age, I think more people know about it. The younger generations, they have so much more access or actually more knowledge usually of obtaining data out there online and whatnot, and they know these things. Whereas, someone like my dad or someone, he wouldn't even consider thinking about secondary market. He'd walk in his local bank and go get a loan. That's
yeah.
But the mentality of the guys like you that are under 40, you guys, what's going on out there for the most part. You know what's available, so you can at least get the process started to go in the right direction to obtain these type loans. And for the most part, it's not as bad as it gets the rap for. A lot of people are like, oh gosh, they're going to want everything. They're going to want a blood sample. That's not really the case anymore. And honestly, in our day and age here too, the products are there. And I would say after 2005, when the market had major issues, all the bells and whistles and things like that, they really kind of went away, and it's a pretty straightforward. Everybody has the same products available out there. It's just a matter of who can provide you the better service, price, and rates.
Right.
That's the main thing now.
Yeah. Do you were Fannie Mae and Freddie Mac, were those real people? Do you know?
I don't know. I doubt it. I mean, I'm sure there's a Fannie Mae, and that probably is. I could probably find a Fannie Mae where I grew up in Camden. That sounds like a good South Arkansas name.
Yeah,
so.
It does. It does. Probably a farm girl,
Probably.
Grew up on the farm.
Yes, I kind of vision Mary Ann from Gilligan's Island. That's what Fannie Mae looks like when I think about it. There.
Yeah. Some overalls, maybe. I don't know.
That's right.
That's awesome. Right. Good deal. Well, I know that you said that a lot of our generation, younger generation, kind of has a general idea of where to go when it comes to applying for a mortgage. I think there's a lot of ways that you can obtain a mortgage, as you were kind of saying. Most people have the same products. But I will say, when, I like to think I was born 2 years too late, because I bought a house in 2022, wish I had bought a house in 2020. And looking back, I think I might have been able to do it. Right. I think we had enough cash in the bank to maybe put down 5%. And of course, everybody's got great hindsight. But, when it comes to applying for a mortgage, what do you think, as far as pre-qualification, getting the process started, how does the mortgage application process begin?
Well, basically, there's a couple of different ways. There's online applications that we can send you to our site to fill out information, and we try to dumb it down to get just the basics to get started. And then I like to follow up, as I tell people, let's get the minimum amount I need, and then let me give you a call and dot the I's and cross the T's. And that's a good way also to keep a good rapport with the borrower and get them. You want to get them to trust you and whatnot. So, you're going to put your personal information there, and the three things that people are going to really look at are, your income from, do you have a good job? Is your income going to be supporting of the type home you're looking at? And assets? Do you have enough of those to cover a down payment and closing cost? And then, basically looking at your history, have you been someone that makes timely payments on bills? And it's, if you can check those boxes, then the process becomes really easy. You do have some complications where you might have people that have, certain type of jobs that are paid a certain way, and they may think they're going to be a walk in the park. Well, John Doe makes $200,000 a year and he's paid in cash. Fannie Mae and Freddie Mac do not like that. You've got to show legitimate non-cash. I mean, it's different. So there are a few things in there that can get you sideways, but for the most part, you have the income that supports, the assets that support, and a good history of on-time payments, then it's an easy process. And you can get in a home if you don't have contingencies where you have to sell something easily within 30 days, start to finish. And it's slowed down a little bit back during mid-COVID to mid-2021. I would have told someone give us 45 days.
Yeah.
We've got a good team here, a fantastic team, and the appraisers and title companies in Northwest Arkansas that we work with, we have really good relationships, and I never stress about missing closing dates. So it's one of the things that I like to do and feel like that can help set me apart from a lot of people is I like to get things knocked out on the front end. I don't like to give a lot of let me sees. Well, I hope this works. Let me see. I've been doing this long enough where I feel like I can tell someone within the first day or two, hey, this is probably not going to work, because you don't want to waste anyone's time. You don't want to waste anyone's money either, because some of these people may be going to go get a home inspection for $500 and want an appraisal for $500. Well, if you're not going to qualify for the loan, you've just wasted $1,000, and I do not want to see that with people. So, doing that, and I tell people here, you gain, like I said, you gain the trust of the people, and if you can save them in situations like that, and they can correct what problem they may have had, well, guess who they're going to call back in 6 months when they've got it all right? They're going to call me back because I helped them so much on the front end, averting the problems, and they trust me, and they want to, use me when things are right. So it's
right.
important, even turning someone down, it's important to do it properly and timely, because it saves a lot of problems and money.
Yeah, absolutely. Well, I think one of the things we want to do here is educate in a way. And like I was saying, I maybe could have pulled the trigger in 2020. Wish I had, of course, but, I don't know if it was me not being in the Sam Walton Business College at the University of Arkansas. I was a Fulbright guy, biology major, and now I work at a bank. But here we are. But still, I don't feel like I had, everything that I necessarily needed. Probably was a Google away. But if people are too lazy to Google and they're listening to this, then here we go. So what is included in a mortgage payment? Is it it more complicated than just paying for a house?
Not really. I mean, there's basically scenario A and B. Scenario A would be 95% of what happens. That would be you pay your principal and interest. You pay 1/12, which would be 1 month of your annual property taxes set by the county, and you pay 1/12. Once again, your 1 month of your annual homeowner's ownership premium, homeowner's insurance. So they call it PITI, principal, interest, taxes, and insurance. And that's what I refer to as an all-in payment. So you've got, Luke Hannon that's buying a house, and his principal and interest may be $2,000, but then he's got $150 a month worth of property taxes and $100 a month of homeowner's insurance. Then his payment just went to $2,250, and that's what you qualify people on, is the whole thing, not just the principal and interest. So one might ask, well, I don't want to put my taxes and interest or insurance in escrow. I want to pay those on my own separately once a year. That's fine, but you have to at least put 20% down on a property, and there is a pass-through fee by Fannie Mae and Freddie Mac charged to the investors, generally it's 0.25% of the loan amount. So, if someone has a loan amount of, let's just say, $300,000, they're going to get charged $750 to waive escrow. So
Interesting.
most of the time, the people that are wanting to waive escrow are the kind that are like, well, they're not going to hold on to my money. Why should they make money off my whatever? And in my mind, I'm like, we're talking about making money off $3,000 a year.
Yeah.
They may make $10, but nonetheless, is it worth $750 not to do that? Absolutely not.
Yeah. They're trying to make it easier on you.
That's right. That's right. And the reason they do that, a lot of people ask, well, why do they require that? And especially if your loan is over 80% loan to value. The reason is because one of the very few things that go in front of a mortgage lien if things go bad is a tax lien. So you sell your house and they're going to collect back taxes before they're going to collect the mortgage or pay off the mortgage.
Yeah.
So that's why it's such a requested thing,
yeah.
so to speak.
So escrowing would be paying that 1/12 every month, right?
Correct.
Gotcha.
In your payment. Your property taxes are $2,400 a year, then you're paying an extra $200 a month in that.
So, and then whoever's holding my mortgage at that time is making that payment timely, making my
every
tax
year.
payment. Yep.
Yes, like in Washington County or Benton County, basically in Arkansas, the tax bills come out usually in mid-March or April, and they're due/late middle of October, and the servicer of the loan will pay those generally probably in April.
Cool.
And
Good deal.
Then your insurance, every year your premiums due, and they will send a bill to the servicer of the loan, and they pay them directly one time a year.
Yeah.
And it's kind of honestly, it's kind of nice not to have to even think about it.
Absolutely. Yeah. I think that's another word that's kind of scary is escrow. Like, what in the world's escrow?
That's all that is.
But yeah, great job explaining that. One thing that's kind of, most of the time I try to act like the listener and act like I don't know what's going on, but this time it's really just going to be me. This is a genuine question that I need to know. Rates for mortgages differ a lot from commercial rates and consumer rates.
Right.
When I'm on the commercial side. When the Fed meets and they bump interest rates, you hear, oh, the Fed bumped interest rates. If they bump a quarter, okay, well, our rates that we are going to lend off of go up a quarter. For the mortgage industry, you could say that the commercial industry, especially as of late, has been more of a staircase where they bump 50, we go up 50. And everything that we do, we're going up 50 basis points. On the mortgage side, how does it differ? Because I know that during interest hikes this past year, the mortgage rates on a 30-year mortgage were hovering around 6.5 for a while. And so how does that market, how do those rates differ? And what influences the rate to be where it's at?
The main influence really is the bond market, and that's what we look at the 10-year Treasury and things like that to watch how that's going. But I think, when you talk about the prime interest rate and how it affects the commercial side and us, it is different, but it's a little bit the same. We get so many calls the day before there's supposed to be a 1/4 or 0.5% hike. I want to lock my rate in before it goes up, and I just kind of let it go, whatever. but the way it works with us is generally these investors, they know within a certain amount of time, 2-3 weeks, whether or not they're actually going to bump the rate. People pretty much know the Powell speakers of the world and all those guys. They kind of let you know. So it's kind of a gradual increase. So, since 2021, when rates were down in the upper 2s to lower 3s, and now they're in the mid 6s, approaching 7, you can see that's, basically 3 to 4 full percentage points. Well, it happens a lot slower over time as far as a little bit each day versus just a huge hit in the one day. And that's how they do it with us. But the same effect is basically there. I mean, your rates in a couple of years have gone up 4 percentage points, and so have ours, pretty much.
Yeah.
It's correlated, but it's not on the same time frame. It doesn't happen, thank goodness, in one day.
Yeah. Yeah.
But it does. I mean, it follows the prime interest rate quite a bit. So
interesting.
Right now, we're like everybody else in the in-house world that lends based on the prime interest rate. We're higher than we've been in a long time.
Yeah.
Historically, yeah, we're still very low. That's historically, but that's not what people are used to.
Right. Yeah.
And one thing in our industry as well, which I'm sure it is in the commercial, is, you know, when you have interest rates going up and up and up, that makes the news. So guess what? People start shopping more. So it becomes extremely competitive.
Yeah.
Because people, you know, when the rate is 3, people aren't really paying as much attention. Like 3%, okay, I'll take that. You know?
Yeah.
Whereas when someone says, well, it's 6.875, they're like, oh my gosh, I didn't know they'd gone up that much. Well, guess what they do now? Then they Google. Then they call someone else. You know, so it tightens the industry, and it makes it competitive. Which, you know, competition, like sports, it's good for everything. It you know, keeps you on your toes and all that. But that's kind of the way it works with the rates and us.
Yeah. Have you seen, I mean, you can speak more specifically to Northwest Arkansas here, but how has the market reacted? We had Cameron Clark on last week, who does the commercial side. But he spoke a little bit on how the market has reacted over the past year and a little bit as to where it's headed. And so kind of if you could break out your crystal ball, your orb, and peer a little bit into the future, maybe speak a little bit on, I don't know if you even want to try guessing what rates will do, but maybe a little bit in the past as well. What's been going on these past 6 months, 12 months, and what do the next 12 months look like if you're brave enough to answer?
I'll give you my opinion. Everybody has one.
Absolutely.
And I also have no shame in admitting I was wrong. When rates got to 5.75 approaching 6 and people would ask, I would say, man, I just can't see how much higher they're going to go, because if they keep going higher, we're going to have problems in the housing market. And if you have problems in the housing market, that's the one thing that just will start spiraling the economy out of control. Well, here we are pushing 7 at sometimes here recently. And so I was wrong there. The glass half full guy will tell you this. I'm hoping in the next 24 months that rates will go down. And if you were to tell me just straight answer up or down, I'm going to say down. And here's why. When I talk to account reps at some of our investors and ask them, hey, why don't you have a good ARM product or a good jumbo rate you can offer me right now? You know, because those rates stink, and you would think with higher rates, people would want an adjustable mortgage, which is basically like an in-house mortgage with you guys. It's only fixed for like 3 to 5 years.
Okay, yeah.
But at a lower rate in the secondary market. And their answer is the same across the board. They say, our people predict rates will come down in the next 24 months, and in that time, the first loans that are paid off are adjustable ones and jumbo loans, because the rates are higher in jumbo, and because the adjustable rates, no one wants in those if they don't have to. So them not offering those type loans because they know they're going to have or they think they're going to have a quick payoff, they know they will lose money on those. So that tells me that they're projecting rates go down. Does that make sense?
Yeah, absolutely.
Okay. So to me, I'm like, okay, well, let's hurry up and fast forward the 24 months and get it back down, but I can't do that. But so I think there is projections for them to go back down some, and it's kind of like the sine wave. It's up and down throughout history.
Yeah.
So I'm hoping this is the crest.
Yeah. I think we definitely love that. I think a safe prediction is they will go down. Keyword eventually.
Eventually, there you go. Yeah. I use 24 months.
Yeah, that's a time frame. That's bold.
I know.
I'll probably be right using the word eventually, but
do you archive these podcasts? Because I don't want you going back 24 months and it's 9 and saying, "Look at this, moron.
It'll show up on my time hop, and I'll come prove you wrong.
That's
Hopefully not though.
Hope not.
Yeah.
Hope not.
Well, hey, I've got one last question, and then if you have anything else you want to kind of speak on that you think would be beneficial for our listeners to know. I know that there are a lot of ways for people, a lot of outlets for people to be able to get pre-qualification, receive a mortgage, and with the prominence of online banks and online mortgage companies, people can go online and apply and do things like that. And so what do you think, as somebody who's been doing this for years in a local setting, what do you think the value is of consulting with a local mortgage lender as opposed to going online, shopping, and by shopping, Jason and I mean trying to just find the lowest rate possible? What do you think the value is of working with Jason Carter versus a Rocket Mortgage or an online outlet?
Well, that's one of my biggest things that I tell people. I'll have a guy moving here from California or Texas or somewhere out of state. They know nobody local, and that's one of the reasons we try to keep such good relationships with the realtors, so they will refer the local people here. And I tell these people, I'm like, here's what I can do. Take a look at it, let me know, and all I ask is that if you don't use me, use somebody else local, because I hate to see you use one of the online companies or people like that, because you're a number to them.
Yeah.
There's some guy in Cleveland, Ohio that doesn't know you. In 30 seconds after you get off the phone, he could care less about you personally or how it affects you here in the community. And they may lead you on for 20 days, and then you're 10 days from closing there, and then they tell you, oh, well, I forgot this part. You don't qualify because of this. And they're not able to be held accountable.
Right.
So I do tell people, I'm like, feel free to shop around. I encourage it. Do your due diligence, but just if you don't use me, I prefer to see you at least use someone local. So you're going to get someone that cares about you a little bit and knows that their reputation's on the line, and they'll take it more serious than someone that's just kind of a bot type person, because that's what it's getting into a lot of times with these people.
Absolutely.
And it's a lot of it is it's kind of like clickbait. They'll be like, call so-and-so mortgage and take advantage of our 6% deal. And then they start talking fast or show you the real small print. And at the bottom it says, yeah, and that's with 3 percentage points added to the closing costs.
Right.
They don't tell you all that, but then you call and they get you on the line and on the hook. But that's all I would say is, they don't have any programs that are better than ours. If they have a lower fee or a lower rate that day, then sometimes that does happen. But for the most part, we're going to be pretty close. If not better. So I definitely encourage people to use local.
Yeah.
It's and like I said, even if it's not me, just use one of my local competitors rather than the other guys.
Yeah. Well, that's a statement with a lot of humility. So thanks for sharing. Yeah. And that's pretty cool. A pretty cool outlook on it. So keep Fayetteville funky, right? Support local.
Right. That's right.
Hey, I got breaking news.
Okay.
Rory just hit a hole in one. What do you think about that?
Well, the rich get richer.
Man, he was so close. He was so close at the Open.
I don't think Rory's going to call me for a need of a mortgage. But if he did call, that'd be cool, just to talk.
Yeah, cool accent, cool guy.
That's right.
Jason's a wonderful golfer, by the way.
Oh.
So I've heard.
Washed up may be the term. Washed up could be the term.
Yeah. Well, do you have anything else for the betterment of the listeners today?
I think we've covered most everything, Luke. The only thing I might add is, there are a few programs that we have here at Generations to help first-time home buyers. There's some grant funds available and things like that if someone wants to learn more about, I'd love for them to reach out. And, I can't promise you good looks, but I can promise you good service with me.
That's right.
That's, you live, you're only as good as your last deal closed. So that's kind of the way I go through life. And, you mess up one and it takes a while to recoup. So, you're going to get my attention the whole time.
Yeah. Well, Jason handled my wife and I's mortgage and did a wonderful job, was very on top of it. And we had a very timely closing. And the title company, who is a third party, didn't know I worked at the bank, was very complimentary of Jason's work. So thank you for hopping on. Are the Hogs 9-3 Razorbacks?
7-5.
Come on.
We're one injury away, Luke, and it seems like the last 2 or 3 years in every sport we've got just cursed by that one injury.
I know.
Sorry, I just got my glass half empty there. I apologize for that. But
You're definitely not getting an invite back. Sorry.
Oh no.
Well, I know you'll be cheering for us to go undefeated.
Absolutely.
But you're
nothing I would like more than 9-3. Trust me.
Well, thanks for coming on, Jason. It's been very informative for me, and I hope it's informative to our listeners. So thanks for opening our eyes to the mortgage market and a little bit about what you do.
Awesome. Well, I enjoyed it, Luke, and we'll be tuning in to your next one, too. Look forward to it.
Thanks, sir. Talk to you later.
All right, buddy. See ya.